interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Welcome to the Raw Selection Private Equity Podcast, interviewing the leading private equity executives and unlocking their secrets to success. Joining us today is Stephen Madsen, Director of Business Development at Monomoy Capital Partners. Welcome and thank you very much for sharing your insights with us, Stephen.
Alex, thank you for having me.
So, Stephen, as is customary on the podcast, if you can share a 60 to 90 second breakdown of you, please.
Absolutely. So Stephen Madsen, Director of Business Development Capital Markets at Monomoy Capital. Have been with the firm for just shy of 6 years now. Joined as our first business development hire, brought on to build out the function, grow our deal sourcing efforts, help build out the team, which we've done. And over the last 6 years have really been focused on growing Monomoy's top of the funnel deal flow, as well as pushing our conversion and helping us deploy capital. Prior to Monomoy, I was with a group called Deal Nexus, did online deal sourcing and deal marketing. It was a sort of independent subsidiary within Intralinks, operated a platform that essentially acted as almost like speed dating, online dating for companies. We would work with private equity firms, venture capital firms, family offices, credit funds, any corporate strategics, anybody who was an acquirer of businesses, and we would help them find bankers, brokers, intermediaries, business owners who were bringing deals to market. At our height, we had nearly 5,500 deals a year marketed on the site globally, with offices in New York, London, and Hong Kong. And we're seeing an average EBITDA of a little over $5 million USD. Got into that from having been an expert networking for about 5 years, working for Gerson Lerner Group in New York and in London, where I focused on covering clients in the private equity, private credit, and hedge fund space. And started my career out actually a different expert network, Coleman Research Group, where I focused on recruiting, vetting, and working with senior executives in the energy industrial space. Born and raised New Yorker, spent some time abroad, lived in Italy for a while, spent some time at boarding school, and came back to New York for college, went to Columbia. So that's my background in a nutshell.
Excellent. Well, I appreciate that. Now, for those listening, this is going to be a huge topic and huge deep dive into deal origination. So I know it's a big challenge within a lot of private equity firms. So we're really going to hit into that. But kick off things, what's one mistake that you see private equity firms or portfolio companies making, and what actions would you suggest to correct them?
That's a great question. I'll stick to origination because that's my area of expertise. The biggest mistake that I see firms making is taking what I would call kind of an either-or approach to sourcing. And by that, if you think about sourcing strategies on a continuum, you have what I'll call the lower market end, which doesn't necessarily mean smaller funds, but there's sort of a lower market approach to sourcing where people tend to be more focused on the number of deals at the top of the funnel, seeing more of the market, and it tends to be very metric driven, very, very top of the funnel driven. And then you have what I'll call the sort of upper market bucket, which tends to be much more focused on deep relationships. So depth over breadth. It tends to be focused on converting the deals that happen to come in and winning the ones that the firm wants. And I often see firms that take one approach or the other when you don't have to. They're not mutually exclusive. You can do both. And so the best, in my mind, best in class business development does both. And so from where I sit, fixing that is a longer conversation. I'm sure we'll get into it. How do you fix it? But it starts with a mindset shift. And so oftentimes at a firm that might be more what I'll call kind of upper market oriented. And again, there are small firms that are upper market in their approach and mentality, as well as obviously lots of big firms. there may be a reluctance to use systems and put in data and collect data that makes it really hard to track the broad breadth of the market and to pay attention to the top of the funnel. And there's often internal politics that hinder that. Got to get out of those mindsets. On the sort of lower market end, there's often a willingness to discount or undervalue relationships. And if you don't value your counterparties, you don't treat them accordingly, it's really hard to have the type of relationship with people that can drive capital deployment, that can drive conversion. And so you can see everything, but you don't necessarily have the depth to get the ones that you want and the depth in your relationships. And so you have to shift your mindset over to one that's more relationship oriented, values those relationships. That's the biggest mistake I personally feel like I see firms making. I see it all the time, and I'm sure we'll touch on it further as we go through.
Absolutely. So from speaking with private equity firms across Europe and North America, two of the biggest challenges that come through, fortunately for me, one is talent. Unfortunately for you, the other is deal origination. So why, from your perspective, why do you think deal origination is such a pain point for private equity?
Well, there are a couple of reasons. To some extent, there's an extent to which inherent in the traditional private equity model, private equity 1.0, you do deals, and when you're doing deals, you're in a bunker. And then you come out of your bunker and you don't have any more deals to work on because you've been under a rock, plugging away, doing the perfect deal for the last however many months. And people have lost touch with you. You weren't looking at your email inbox. You weren't scanning every possible opportunity. You weren't maybe thinking as creatively as you would like to. I think there are likely a lot of firms where their willingness to pass on a deal goes up depending on how many deals they have in house. If they're busy, they'll pass on a lot of stuff and they might miss some great opportunities. And if they're slow, they'll look under a few more rocks and see if there's any value there. So that creates an inherent challenge in origination, that people are just kind of in and out. A lot of firms are start and stop. And so the business development function ultimately springs from a need to fix that and have a consistent market-facing person out looking for every opportunity, really having a constant, consistent dialogue, having someone who's able to say, guys, I know we're busy, but this deal is awesome. Let's dig into it. Let's spend time on it. And then secondarily, you have an aspect where when you have a professional who does that full time, they get really good at it, and you optimize for people's talents. So I think that's part of the reason, certainly in traditional private equity setups. When you think about the market more broadly, I mean, origination is still a challenge. Origination is a challenge for everybody. Part of it is just the fact that there are a lot of opportunities out there. You got to filter through them. You have to pick your spots. And so there's an inherent challenge in covering the market. Everybody wants to see more, but at the same time, you want to spend your time on the relevant deal. And so walking the line, it's just inherently a tough job, and one that we do, can always get better, but do every day.
Absolutely. And so the deal origination aspect, what's your take on, appreciate your position and it's standalone. So what's your take on that being separated as a standalone team and function, which we're seeing more and more of? What's your opinion on the strengths, weaknesses of that?
A great question. It's certainly a proliferating role, and more PE firms are adding business development to their team. Start with the con. The big con or the big negative is that when the investment team is out doing their own sourcing, they can speak immediately and make a snap decision, and you do cut down some lag time where a dedicated business development professional might want to go back and check on something, or might not want to chance missing a deal. So you miss a little bit of, there is some efficiency loss there. Having said that, certainly my experience has been, and I think most of my peers would agree with this statement, probably are better off looking and making sure that you checked out that deal. And it does happen sometimes that something that would have been a quick pass is actually a really interesting opportunity and something worth digging into and spending real time on. And so while there is a slight con there, it is also a pro. When you think about the other pros of building out standalone business development, it tends to make a lot of sense at firms that invest across more than one industry. You have a multiple industry focus. Having one person who sits across, or a team that sits across the firm, that can help cross-pollinate best practices, ideas, political capital that you accumulate with your counterparties in one area, can you spend it in the other area? Really having someone who can speak for the whole firm as opposed to just for a single industry vertical has been immensely valuable. And then you have to have a true partnership. The business development as a truly standalone entity doesn't actually work very well. There are firms that have business development in a silo where they don't talk to anybody except maybe bankers, and they collectors are just out there trying to collect books. That's not a good approach to the market. You want a business development team. The business development team needs to be able to speak for the firm, needs to be working in partnership with the investment team, needs to be able to investment team opportunity, but also that in conversation. Make sure that everything is kind of teed up to allow the to be more or less busy as they need to be, to spend more or less time on sourcing as they need to, and to drive more or less, or hopefully drive more ROI on the time they do spend sourcing.
Interesting. So I think it's like we'll see in markets now, we'll see, portfolio companies, and they'll have a business development and account management function. And I suppose what you're sharing there realistically is it's when you've got a deal in the mix, all you focus on could be closing that deal, or at least you're not going to invest as much time. Imagine if, you're an investor and you've got absolutely no deals in the process, and you're spending all your time doing business development and, or as it's called, deal origination. That amount of time being consistently done all the time is going to bring more deals and more deal flow in. So it kind of makes sense in a simplistic fashion. I don't like the term business development. It's a weird title to have. Deal origination, much preferred from my perspective, but that doesn't mean anything. It's opinions only small. But so basically it's that kind of standalone position, opportunity to drive. Sounds great in premise. Obviously it's additional headcount, additional cost, no doubt from that perspective. But what kind of returns would, if I'm managing partner of a private equity firm and I'm starting to think we could really do with this, which I know a lot of firms are, and we're seeing an increasing hiring criteria, especially in the States. The UK's and Europe's usually slow to catch on to emerging trends in private equity. But what have you seen from the kind of results of having this as a standalone position and indeed standalone team as you have at Monomoy?
So it's a great question. There is some fantastic data from Sutton Place, and I don't have it handy, unfortunately, for this conversation, but they published some data years ago looking at market share and the breadth of a firm's target market that they cover and how that relates to returns. And not shockingly, if you have a wider swath of your target market to look at and you have more opportunities to pick from, you can pick better opportunities and you make more money. And at the end of the day, it's all about driving returns. We're in the business of buying companies, improving them, and hopefully selling them at a profit. And when you can better pick the companies to buy and you have more opportunity, you can sell them at a bigger profit. That's the whole idea. Within Monomoy, I think, we have more than somewhere between tripled and quadrupled our total flow top of the funnel. We're able to be more selective. We've doubled the rate at which we close platform deals, if you look at the 5 years prior to having a business development function versus the 5 years post. And so that's a testament to our ability to look at a wider swath of the market, be a little more selective, but also deploy more capital faster. And it's been I think it's been a really successful run for us, and continues to be. One note I'll make for your European audience: origination in Europe is obviously very different. The availability of information makes the role very different in Europe. Companies, for example, in the UK, publicly filing their financials with their taxes allows you to plan or look at your target universe with just a wealth of data that we don't have here. So we can pick that up later if it's interesting, but it's a very, very different, when I would go across the pond and meet with clients at Deal Nexus, European origination is a little bit of a different ballgame, and business development adds value, but it's a different approach to the market.
Okay, so let's explore that. Do you think it's simpler from a perspective of European, without doing discrediting, but do you think because of the data available, it makes it simpler? Does that make it more complex because you're overkill with too much information? I suppose you've seen the US model and obviously experienced in doing deal origination in Europe. Which one would you rather have, all that information or the US type lack of information? I'd guess it'd be the latter. The first.
It's funny. No one's ever asked me which I'd rather have. I'd always, obviously, any investor, you want more information. It's a very different sales cycle, or sort of cycle time in Europe versus the US. So if you're sitting in the UK and you know that you're looking for companies with, call it, more than 10 million pounds of EBITDA, you can go into the tax databases and you can pull that list up and you can narrow it by industry and you can do research and look at their website. And now your goal is to be in front of the owner of that business, potentially years in advance of the decision to sell. You want to cultivate a long-term relationship. Now, they'll still probably bring in an investment banker, an advisor, someone to help them sell the business and optimize value and potentially run a process. But you're planting your seeds, hopefully, directly with the owner. It's a different conversation, and a much longer conversation. Now, in the US, obviously, we do that too. We do a lot of proprietary outreach. We talk to business owners on the regular. And yes, here it's a long sales cycle for those opportunities. It's a very similar sales cycle to what you see in Europe. For most deals, though, in the US, because there are so many companies, and because it's really hard to distinguish a company with 15 million of EBITDA from a company with 50 million of EBITDA from a company with 500,000 of EBITDA, you end up, the private equity community outsources a lot of that long-term relationship building to the investment banking community, who in turn gets referrals from lawyers, wealth advisors, accountants, you name it. Those referrals come into the investment banks, they vet the opportunity, they prep it for sale. And so much of the job of business development in the US is talking to intermediaries, talking to counterparties on the banking side, building those relationships. There are funds that eschew that entirely and want to talk directly with corporate development departments about their divestitures, or want to talk to business owners directly, and they build long-term databases and they look for proxies of the data to help them figure out size. For example, a lot of companies that invest in technology look at the number of employees on LinkedIn that a company might have to get a proxy for size. In other sectors, the number of employees industrial business has on LinkedIn, probably not a relevant indicator for the size of the company. So but when you talk about business development broadly, when you take a step back and say the function as it exists across private equity, that is the big difference between the US and many countries in Europe, is that you are doing collectively, business development is much more focused on banker relationships. Whereas in Europe, it's more focused on building those long-term business owner relationships because you can pick your targets with a lot more accuracy.
Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast. That's interesting. Certainly something I didn't know. So if you're looking at those intermediary relationships, for our side, you think, well, do you know what? Yeah, the investment banks want to sell, obviously want to support a process. There's God knows how many private equity firms have just released a blog with it, but I can't remember the number. But there's obviously a lot of private equity firms, all of them invest, of course, in the same space and would consider the same business. But it's a competitive landscape. How important are those relationships to A, get in the door with these opportunities, B, be considered, or C, just even have a seat, that kind of relationship to be able to close a deal for them to be aware? Is it just if they know who you are, you've got a chance of getting in, or is it the warmer relationships are important? Just give us a perspective of how important that aspect is with the intermediaries.
So that aspect is vital. And there are a couple of pieces of having an intermediary relationship and making it work well. There's getting the look in the first place, which is about getting on the buyer's list and getting that buyer's list approved by the seller so that you can take a look at the business. There's having a relationship with the intermediary where you can better understand the business and the company and sometimes the competitive dynamics and what needs to get done. And then there's managing that relationship on an ongoing basis so that you have a repeatable process for building, running, talking to the market and that the intermediary segment of the market. Each piece of the process is really important. Each piece is different. Sometimes the best way to get on a buyer's list is to talk to the VP or the associate who may be closer to the actual building of it. Sometimes it's going in through an MD. We at Monomoy spend a lot of time tracking opportunities, sometimes years before they actually come to fruition, when a bank is pitching a deal or tells us about something that they think could come up for sale down the road. We'll track those opportunities. We'll hopefully convert them into our active funnel. And we see every variety of impact in our relationship. Sometimes despite all of our best efforts, someone's upset at us and we can't get into something. Sometimes we're not thought of for a deal for whatever reason. And we have to leverage our relationship to get the guy or the gal's ear and say, hey, here's why we're a good buyer for this. Here's why we might be, really competitive in this process. And then once you're in something, the ability to have the mind share to better understand the business. I mean, if you think about, you've ever been to the viewing of a house, a real estate agent may spend a little bit of time with you. They may spend a lot of time with you. Sometimes when they spend a lot of time with you, they tell you things about the house that make it more interesting you didn't know, or maybe help you understand the fuller picture or the history or the maintenance or what needs doing. And you can be a more informed buyer. And it's the same thing with the bankers. If you have the relationship, you can be a more informed buyer.
Sounds like a full-time job in itself, Stephen, to get that.
It is.
Those relationships, never mind the deal origination side. So so we're in with those relationships and having that. Obviously, I'm going to assume private equity, I know private equity investors will have good relationships with some where they're doing if you want to call it the 360, the full approach of deal origination, closing, everything else. How many relationships would typically a deal origination professional hold, across the sphere of intermediaries?
That's a really interesting question, actually, and it's something that I've been spending some time on, and my team has been spending some time on. And when I come up with the optimal answer, I'll let you know. And I'll elaborate on that. It's a really interesting question because you have some of the best BD efforts in the country are 1 or 2 man bands, and they seem to know everybody, right. And everybody knows that. And I could sit here and reel off a list of names like that. Then you have firms like Monomoy or Riverside Company who have built out real teams and have said, no, we need to have more coverage in order to have the depth of relationship. And I think we've seen real ROI on building out the team and having more relationships. It depends to some extent on what your investment team is doing. So if your investment team is also doing a lot of sourcing and they're active and they're out there in the market, you might be able to do you could potentially have a very small team or one-man band that is in many respects coordinating and supporting the investment team's organic efforts and doing blocking and tackling when one of the deal teams or one of the leads is in the trenches doing a deal. And so they're kind of there to run interference, provide support, spot, et cetera. Some other firms, the investment team, for one reason or another, personality, focus, goals, whatever it is, they don't necessarily like being out there in the market. And maybe they just want to work on building the perfect model and figuring out the true intrinsic value of the company. And that's okay. But you may need a larger business development effort to help those people interface with the market. So it runs the gambit, and I don't have a good answer for that question. I know people who I think have 1,000 real relationships, and I think you could also make a very compelling argument that max a business development professional should cover 15 or 20 firms, and I don't think either of those is necessarily wrong.
Depends on your business. No, I appreciate that. And
depends on the business, depends on the fund.
And how do you, I mean, it might be a simple question, a simple answer actually, but I'm sure there's more detail here. How do you measure the success? So if I'm a new managing partner, I'm a managing partner, private equity firm, I'm thinking, right, we want to do this. How do I measure the level of success we have? Typical of anything in a business, we want success instantly. That's not going to happen certainly in the US with intermediaries, and even in Europe with the amount of data we have. How would you kind of measure success, or how do you measure the success of things currently?
So I would view it the following way. There are near-term immediate indicators that should show that your effort is bearing fruit and it's on the right track. And then there's the long-term proven success. Mm-hmm. Over the long term, capital deployment should increase. The rate of capital deployment and the quality of capital deployment, so eventually returns, should increase. Figure 2 to 4 years to see capital deployment go up and a typical hold period for your portfolio company to see that capital deployment result in improved returns. So that's the long-term proven metric for success. The only metric that actually matters. If you're not getting to those results after a couple of years, you need to reevaluate your efforts. But that takes a long time. So what are your near-term indicators? If you're building a business development effort from scratch, and certainly when we started at Monomoy, the thing that ticked up immediately was teasers in the door. And that not every one of those teasers was a quality deal. And for the first few months, just getting more looks or tracking even what was coming in, that was a good indicator that we were on the right path. We were getting the message out to more people in the market. We were learning, we were refining our approach. And as we went from teasers in the door to more conversion to books, eventually more conversion to bids, it takes longer, but you see over time, you see those metrics phase in. So you want to see improved quality. And then eventually the sort of medium term result, if I can say that, you're not necessarily focused on volume. I think bad business development is characterized by a relentless focus on top of the funnel volume. Eventually, you still want to see you may want to see the deals at the top of the funnel, but eventually you want to be getting more selective. And so it's actually a good indicator when you start saying, you know what, we would have bid on that business 6 months ago. We would have bid on that business a year ago. Now, when I look at the rest of my funnel, it doesn't rate. It's not that interesting. And so this, I think is another good kind of medium-term indicator. If you start looking at businesses and saying that was interesting or would have been interesting before we had a wider view of the market, but today it's past. That's phenomenal. And your investment team should be making those types of decisions and saying, we don't want to bother with this the way we would have once upon a time. But then BD should be making those decisions and saying, you know what, we're just gonna, we've looked at this, we understand what the firm wants, we know the criteria, and maybe you sanity check yourself if you're on the bubble. But over time, you should get more and more confident and say, you know what, this deal is not for us. And the results should prove out with a more efficient use of investment team time. And again, ultimately better returns and more capital employed.
Interesting. So it all just comes down from moving away from scarcity to plethora of opportunities, and therefore your standards will rise on the back of that. And therefore you're saying there that there's going to be deals that you looked at, they go, we'd probably bid on that, but now that's not good enough. We've got so many options. These are better. These are the ones we really want to secure, which is obviously only going to return capital faster and drive better performance for LPs.
That's exactly right.
Okay, so what advice, you've shared a lot here, but is there any additional advice that you would share, Stephen, for kind of small mid-cap firms to increase their deal origination, obviously other than actually separating that as a division?
This seems so basic, but take notes. The number of times I walk by, I see, we go to conferences. It doesn't matter if it's a big industry show. For example, go to the big auto aftermarket show every year, or if it's an ACG type conference, so a deal sourcing oriented conference between private equity investment banking or anything else. The number of times that I see PE folks who I recognize, who I know, and they're not taking notes. And I know what their schedule looks like. They've got back-to-back meetings, and they don't necessarily have a note taker with them. You're going to forget a lot of valuable details. It is not uncommon to look back at the end of a busy day and say, oh, I completely forgot about this call. That was a really interesting tidbit, or there's a really interesting lead on there. I was talking with there's a deal that we ran very hard at last year. Unfortunately, broke against us, but we had that was a deal that someone on my team went back through their notes and said, "Oh, this is the one." At the end of an extraordinarily busy day, and proceeded to do a lot of bird dogging to kind of get around it. So it's it's so basic. But people people don't do it, and I understand the desire to focus on the here and the now and not to deal with paperwork, but it's invaluable.
Very good piece of advice. So moving away from deal origination to a little bit of kind of talent, what do you what three aspects do you believe make a top performing individual?
So I'll say a couple things. First off, I mean, grit. The willingness to just knock your head against the wall and work hard and get something done. There's no substitute for it. There's plenty of research that shows how important grit is. I think one of the lessons, something that one of my mentors taught me just by doing it, was that sometimes it's not worth it to try to figure out a clever way to make the busy work go away, or the manual or the data entry, whatever it is. Sometimes you just have to sit there and do it. And the grit, the willingness to stick to it, the willingness to just drive through that, there's no substitute for it. The next thing in my mind is passion. You can have all the grit in the world, but if you're not motivated, if you don't have fire in the belly, and for most of us, if you don't love what you're doing, very hard to succeed. And then I'll say I think this is important generally, but it is uniquely important in BD. You got to be quick on the uptake. I think there is an essential need in business development where you're talking to people all the time and you're diving from topic to topic. You better be able to pick up really quickly on what's being said to you. You've got to be able to learn mid-conversation. I occasionally use an interview question that's designed to be kind of totally outside the box and to see, do people pick up on have they done this in the past, and also how do they respond to a question out of left field. I'm not going to reveal it on this podcast because I don't want to come up with a substitute, but it's a quickness on the uptake. There's no substitute for it, at least not in PD.
Okay, we'll leave that as a mysterious one to prepare your interviewees then to get there. So what do you love about private equity industry, and what do you dislike about it, Stephen?
I love the people. I find PE to be full of fascinating, intelligent, interesting individuals, some of whom are total characters and a ton of fun, some of whom are just quiet and hardworking. But I have found it to be a great place to work and build relationships and be in the market. And as I think back, back in my expert network days, I had clients who were on the private market side, so private credit, private equity, and I had clients who were on the hedge fund side. And I'll take private markets any day.
Excellent.
What do I dislike about it? We don't have standardized NDAs like the debt markets do, and we really need them. One of the little painful tasks of sourcing deals is dealing with the NDAs, and I gather from my friends in the debt markets that they have a click-through standardized thing that everyone's agreed to, and for whatever reason, we've never been able to get that in private equity land.
Well, collective decisions in private equity might be a bit of a difficult move, but obviously, debt markets managed it.
One of my mentors tells me that once upon a time he took a run at trying to get something set up, and told me he would need several drinks to tell me how that went. So.
All right. Okay. Well, obviously didn't work out. So painful.
Didn't work out.
Painful experience, no doubt. So what educational resources, what would you recommend that others in the industry check out?
So I think, there's, well, it depends on where you're coming from. I think there's a wealth of of information now about business development and about private equity through podcasts like yours, through resources like newsletters like the Hub, and out there in the world. One particularly interesting font that I've been able to draw on is the search fund community. So a lot of private equity firms think they're really good at deal sourcing. But if you go hang around with the search fund program people at Stanford Business School, Harvard Business School, U Chicago, where they're prepping people who are going to come out of their MBA programs and spend 2 years exclusively looking for one company to buy, and they get one shot and they have to get it right. And they're going to buy a small business and there are a lot of targets. Those folks are really good at sourcing. And one of the real privileges of my experience at DealNexus was getting DealNexus picked up by the entrepreneurship through acquisition class at Harvard. And we worked with IE as well in Spain. But we actually, I interacted with a lot of the students and some of the people who worked with the professors, and the level of kind of data that they're collecting, because all the searchers send back their experience and examples of letters they've written to business owners and emails, scripts they use on calls, and I mean, they're collecting this effort across hundreds of searchers. Some of whom go proprietary outreach, some of whom rely on sort of smaller brokers and intermediaries. It is a wealth of information and a really interesting community to spend some time around. And so, there are resources there. There's a bunch of blogs that cover search funds. There's each of the business schools does a search fund conference. So if you're looking for an out of the box suggestion for the day, and you want to learn about origination, there's some really cool stuff in search fund land.
Thank you very much for certainly sharing that. I've not heard of it, so I'll even take a look myself. So if anybody wants to reach out post this podcast, Stephen, how best do they get in touch with you, please?
My email and phone number are on the Monomoy website, so or you can find me on LinkedIn. So Stephen Madsen on LinkedIn, or smadsen at mcpfunds.com.
Perfect. We'll stick that in the show notes for anybody to reach out. Well, Stephen, you've given us an absolute deal origination overhaul there. So I really appreciate everything you've shared. And thank you very much for joining us.
My pleasure, Alex. Thank you for having me.
As always, thank you very much for joining us. And of course, should you ever need support with private equity professionals or portfolio executive hiring, please do reach out to me at Raw Selection. But till the next time, keep smashing it. And thank you very much for listening.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.